today. Welcome to another edition of Economics with Tully. This is Tom Simmons, and today's the subject of today's video is monetary policy. And in order to bring you today's video, we are at the Museum of American Finance on Wall Street in the heart of New York City's financial district. Monetary policy is a very specific type of policy that our government, specifically through the Federal Reserve System, uses in order to manipulate, massage, attempt to correct or direct the economy. And even though we might use the word monetary to mean anything having to do with money, it really is a very specific set of principles, a very specific set of policy tools that is used whenever we seem to run into higher than desired rates of unemployment or inflation or deflation occur. If you've seen my previous video on fiscal policy, you'll remember that people who embrace fiscal policy prefer to see Congress, our government leaders, use taxing and spending policies in order to regulate the economy or to jumpstart it when it seems sluggish. They believe that by controlling aggregate demand, which is the demand of all the consumers in the marketplace, that they can jumpstart the economy. Monetarists also believe that the key to regulating the economy is regulating aggregate demand. Unlike fiscal policy adherents, however, monetarists believe that you don't do that through Congress, but that instead it should be done through a professional banking system that controls the supply of money. And to get an idea of what that means to control the supply of money, the first thing we need to understand is how it was not controlled in many of the early years of our country's history. For instance, if we pan around this room, you get an idea of all the different types of currency that were in use. Right through the American Civil War, we were still using foreign currency within the United States. Individual banks issued their own notes. States issued their own currency. The very first American currency was actually based on the Spanish pieces of 8, which you may have heard of or remembered from the Pirates of the Caribbean movies. It actually took a very long time for currency or money to be standardized in this country. And part of that occurs with the establishment of the Federal Reserve System. The idea here is simple. If the amount of money is expanded in the economy, if it's easy to access money, then it's easy to encourage people to borrow it and then spend it, to put a deck on their house, to buy a new car, to go on a vacation, to spend money that they may not have because they're able to borrow it. On the other hand, if we're concerned that people are spending too much money because inflation is taking off, then we want to reduce money supply. If we can make it harder to borrow and harder to access money, then people will spend less. And especially larger corporations and those who deal with enormous quantities of money will find it harder to borrow and harder to spend. In looking at money supply, There are many different ways to measure money supply. The most common is M1, very creative name. M1 refers to the amount of physical cash in circulation, the actual coins and the dollars that you have in your pockets, because it's the most readily usable and is considered the most liquid. Another element of M1 is the money in your checking accounts. Checking accounts technically are called demand deposits, and that's because once that money is in your account and has cleared, you have a right to demand it immediately. The third element of M1 is something that very few of us ever use anymore, but they used to be used with quite some frequency, and those are traveler's checks. And traveler's checks used to be a paper check that represented a certain amount of cash that you had given to the bank that could be used when you went traveling. It used to be the safest way to bring money with you when you travel because everyone treated it as if it was money. But if you lost it, it could be replaced. With the advent of debit cards and ATM cards, the use of traveler's checks has declined considerably. Nonetheless, those three elements, traveler's checks, money in checking accounts, and cash in circulation, constitute M1. That is the most important measurement that monetarists are going to look at in determining the health of the economy. The second measurement is like it, M2, and it includes those first three elements, plus one more. It includes money in your savings account. Money in a savings account is not quite as liquid or readily usable as money in a checking account. In fact, your savings account is not a demand deposit. It's actually called a time deposit. And that's because if you go to the bank and say, hey, I'd like to withdraw the $20,000 from my savings account, the bank has the right to actually say, okay, come back in 3 days for it. Because not all money is on hand in the bank, and they cannot be guaranteed to have that cash sitting in a drawer waiting for you. Banks make their money by loaning money to others, and they don't keep that money in the bank. So M2 is just a little less liquid. It includes the three elements of M1 plus savings accounts. Now, to get an idea as to how we control the amount of money in circulation, how we control M1 and M2 in order to manipulate consumers' demand, we need to talk a little bit about, again, history, the early days of our nation, and then the advent of the Federal Reserve System. We're now in the Alexander Hamilton room of the museum, and Alexander Hamilton is widely regarded as the architect of American finance. He served as our first Secretary of the Treasury after the Revolutionary War, and if you put yourself back into those days in the late 1700s, financially the country was a mess. The U.S., the federal government was in debt. Soldiers hadn't been paid, states had incurred debt, there was no single currency, there was very little way to borrow from other people. We had already borrowed from France and the Netherlands simply to run the war, to run the Revolutionary War. So Alexander Hamilton basically designed our very first banking system and presented a plan to create the first national bank. Now, most nations around the world have a central bank. It's their national bank, it's the government's bank. This was Hamilton's idea as well here in the US. He established, or helped to establish, that first national bank, had the federal government assume all of the debts that the states had incurred during the Revolutionary War, and then proposed a series of taxes and tariffs to raise money for the federal government. The number one way that the federal government was expected to raise money was through tariffs on goods being shipped into the new nation. Problem was, we had a long ocean border and a lot of people smuggling goods in to avoid paying those taxes. So Alexander Hamilton then suggested the creation of something called the Revenue Cutter Service, which you know today as the U.S. Coast Guard. That lasted only a brief period of time, not the Coast Guard, but the bank. The First National Bank lasted a brief period of time to get the country running. There was a second national bank, and there were other national banks. By the late 1800s, however, there still was no central coordination of the money system in the country. And during the late 1800s and early 1900s, there were a series of bank collapses. People had put their money in banks, and they went to withdraw the money, and it wasn't there. As I said earlier, banks don't make money by keeping your money in the bank. They make money by lending it to others. Sometimes those loans are good, sometimes they're bad. In either case, the money's not there. And when people run on the bank and demand their money back, and it's not there, the bank begins to have a problem. The community begins to have a problem. We had a series of those. We also had a series of inflationary periods where prices seemed to be going up very fast, faster than people were comfortable with, faster than their wages were able to cover. 1913 rolls around and we create the Federal Reserve System. Federal Reserve System was created largely to try and stop these bank failures, and was also given the double job of preventing unemployment from getting too high and preventing inflation from getting out of control. To be fair, and to be honest, most people who embrace monetary policy as an economic planning tool probably generally, over the long term, are a little more concerned with inflation or even deflation than unemployment. Fiscal policy people tend to embrace employment as the issue to solve. Monetarists tend to see inflation as an issue to keep under control if you want to keep your economy healthy. In designing the system was designed to be as removed from politicians as is physically possible, while still being a quasi-government system. The Federal Reserve System is a private-public banking system given certain monopoly powers by the federal government. And in order to understand how the system operates, I need to describe how it's structured. And there's three layers to it: a local layer, a middle layer, and then the very top. At the very bottom of the Federal Reserve System, the nation is divided into 12 regions or districts. These regions, in many cases, cross state boundaries. New Jersey is in more than one. Many states are in more than one district. Most of New England, except for Greenwich County, Connecticut, is in the Boston Federal Reserve System. We are here in the heart of New York, so we're in District 2, the New York Federal Reserve District. All of the banks that have a national charter, all the private banks that have been licensed by the federal government, are required to be part of the system. If your bank is a state-chartered bank, the option is theirs, and the majority choose to be part of the system, so that by and large, some 95% of the banks in the United States have entered into this system. The member banks of each district actually vote on the board of directors of the Federal Reserve Bank in their district. So you've got all the private banks in New England will get together and vote on who the board of directors are for the Boston Federal Reserve Bank. All the private banks in Minnesota will get together and vote on who is on the board of directors of the Federal Reserve Bank of Minneapolis. It's a very decentralized system, and private banks have a lot of control over who runs the bank for their district. That's how the bottom level is organized. The top level comes through the President and Congress. At the very top, The president appoints 7 governors. They're called the Board of Governors. They have 14-year terms, and one is up every 2 years. So that it's unlikely that one president, even if he or she had an 8-year term, would actually appoint the majority of the board. They have these long 14-year terms. They are often reappointed unless there's good reason or cause for them not to be. And they tend to be very well connected to the banking system and to the financial industry. The chair of the Federal Reserve has a 4-year appointment. As I said, the president makes the appointment to the Federal Reserve Board of Governors, and the Senate must concur through the advice and consent of the powers of the Senate. Those 7 people then become the Board of Governors that oversee the operation of the entire system. A few names that you should keep in mind. One would be Alan Greenspan, who for most of my lifetime was on the Board of Governors and the chair of the Board of Governors, and who brought a very, very conservative, tight-lipped approach to the activities of the Federal Reserve. Newspapers would always try and get him to say something to report, and he was always very reserved. The Federal Reserve would have a meeting, and he would come out, and when asked questions, he would basically say things such as, the Federal Reserve has considered monetary policy, we have looked at the money supply, we have checked our figures, everything is in good hands, thank you, good day. We had a major change when Ben Bernanke became the head of the Federal Reserve System and the chair of the Board of Governors. Ben Bernanke was very public and very willing to talk to the press and talk to reporters and talk to Congress. Of course, Ben Bernanke was also the chair of the Fed at a time when our economy was melting down during the Great Recession that started in 2007 and 2008, and he was expected to address the press. But what it did was, it changed the personality of the Federal Reserve System. In the past, the Board of Governors always spoke in public with one voice to assure the public that everything was in control. Now it is very common for other members of the Board of Governors to disagree, and to disagree openly with the current chair. Well, Ben Bernanke has left, and the new chair, as of the time of this filming, is Janet Yellen. Janet Yellen is the first female chair of the Federal Reserve System, and in many respects she has gone a little back towards Alan Greenspan's approach of being a much more conservative mom to the whole system, and just reassuring people that they're on the ball and they're watching for everything that's going on. The real power in the Federal Reserve, however, is not at the 12 district banks at the bottom, and it's not with the 7 Board of Governors at the top. The real power is in a structure in the middle called the Open Market Committee, or the Federal Open Market Committee, often abbreviated the FOMC. The Federal Open Market Committee is the part of the Fed that is given the power to regulate the economy. Its members consist of all 7 of the Board of Governors from the top, the president of the New York Federal Reserve Bank, always, and then 4 other district or regional bank presidents, and they rotate through them. So you've got this balance between bank presidents in the regions and Board of Governors at the top, always with New York, because quite frankly, the New York Federal Reserve Bank is arguably the most influential and powerful financial institution in the world. They come together, and they are the ones who set policy. These policies are the tools that are used to regulate the economy, and we're now going to take a look at what those tools are and how and when. There are three basic tools that the Federal Reserve System uses to regulate the economy. The first is the discount rate, which is the most commonly one reported on the evening news. And the discount rate is merely the interest rate that the Federal Reserve charges member banks to borrow money from it. So for instance, if the Federal Reserve lends money to your local bank at 5%, then in order for your bank to make money on that, they're going to have to charge you more than 5%. They'll have to charge you 6, 7, or 8% in order to make money on that. Now, if the Federal Reserve should decide to increase the rate at which they lend money to your local bank, and they start charging your local bank 7 or 8%, then your local bank will have to charge you 9, 10, or 11% in order to make money. So when the Federal Reserve increases the discount rate, or the rate it charges local banks, it is hoping that as a market effect, those local banks will increase the interest rate that they charge local borrowers. Now, why would they want to do that? Well, if the Federal Reserve believes that inflation is taking off, that people are spending too much money and it's putting an upward pressure on prices, they will raise the discount rate, which may seem counterintuitive to you. Prices are going up. Why are they making money more expensive? Well, because by raising the discount rate, they're hoping they will discourage borrowing, and people will be less likely to borrow money to put on that deck, or to buy the pool, or to buy the car, or to do the other things they were going to do by borrowing money. On the other hand, if consumers have stopped spending, which was a fear after 9/11, another fear after the 2007-2008 financial recession that we had, they will lower the discount rate in the hope that by charging local banks just a little bit to borrow money, that those banks in turn will be encouraged to lend money to borrowers at a very low rate, and that will encourage borrowing and therefore encourage spending in the economy. So if we are in a period of unemployment, they're going to lower the discount rate to encourage borrowing and encourage spending. If they're concerned inflation is going to take off, they're going to increase that rate in the hope of discouraging people from spending even more than they already are. That's the first tool. That's decided by the Federal Open Market Committee every 6 weeks when they meet. The second tool they're going to use is something called the reserve ratio. Now, you'll recall earlier I said one of the purposes of the Federal Reserve System was to try and stop bank failures. Well, one of the ways they do this is through the reserve ratio. And the reserve ratio basically is the percent of deposits that a bank must keep on deposit in their vault and not loan out to someone. So if the reserve ratio is 10%, when you deposit your paycheck, let's say, or you deposit a check for $1,000, the bank is required to keep $100 of that in a drawer in case you come looking for it. They are permitted to loan only $900, not the full amount. This is an effort to prevent bank runs. But it also becomes a tool for regulating the economy, because if the Federal Reserve increases the reserve ratio, if it increases the amount of money that banks must keep on hand, that reduces the amount of money in circulation available to be loaned out. On the other hand, if they lower the reserve ratio, if they say to banks, you can keep less money on hand, it makes more cash available to lend, again with the hope that that will encourage people to borrow and people to spend. The third, and perhaps the most important tool that the Federal Reserve has, is one that's probably the least understood. And those are called open market operations. And that involves the buying and selling of U.S. Treasury bonds, and there's an entire wall of bonds behind me where I'm speaking right now, at the Federal Reserve Bank in New York, which is the branch that is charged with carrying out this operation every single day of the year. You've probably had a savings bond at some point in your life. Grandma bought you a $100 savings bond, said use it for school or something like that. Well, what happened when she did that was that she loaned money to the federal government, and they in turn gave her a piece of paper. It's an IOU. That's what a bond is. It's an IOU. It says, we promise to pay you back with interest on a certain date. That's how the federal government finances its operations. We spend far more than we take in, so the federal government borrows money. When it does so, it borrows money and it gives a bond in its place to the institution from whom it borrowed the funds. That's a promise that they will pay back that money with interest at some future date. Now, suppose you had one of these pieces of paper that said the federal government was going to pay you $1,000 if you hold on to it for 7 years. And I came along and said to you, you know what? I'll give you $950 right now for that piece of paper. That's actually a good deal, because $950 today is actually worth more than $1,000 7 years from now. So chances are, if you were financially savvy, you'd say, great idea. Take my paper, take my bond, and give me the money. That is essentially what the Federal Reserve System does every single day in New York. If they think there needs to be more money in circulation, if they want to increase money supply, they will give good deals to financial institutions and banking institutions and investing institutions and the general public by saying, we're going to give you a great deal, we're going to give you money for your bonds. So those financial houses sell the bonds to the Fed, and the Fed gives cash to whoever it was who sold them the bond. That increases money in circulation. If the Fed wants to expand the economy, if they want more money supply, more consumer spending, that's one way to do it. They give a good deal on buying bonds from the public. If, on the other hand, they feel that inflation may be taking off, then they want to take money out of people's hands. And the way they do this is by selling bonds to the public at a really good deal. For instance, if your stocks or your bank are only paying you 2 or 3%, and the Federal Reserve says, we're going to sell you a bond, and it's going to pay 5 or 6 or 7%, you might be very encouraged to make that investment. When you buy that bond from the Federal Reserve System, you are giving them cash, and they are giving you paper. The Federal Reserve then takes that cash and gets it out of circulation. So by manipulating the prices of U.S. Treasury bonds, the Federal Reserve is actually able to put more cash out in circulation or grab it out of circulation, really by trusting that you're going to make financially savvy decisions, or that financial houses are going to make financially savvy decisions. So those are your three basic tools: the discount rate, the reserve ratio, and open market operations, which is the buying and selling of these bonds at discounts or premiums that result in an increase of money in the economy or a withdrawal of cash from the economy. So from time to time, financial processes don't work out exactly the way that we would hope they would. And we certainly saw this almost 100 years ago with the great stock market crash of 1929. And unfortunately, most of us have just lived through another, what we have come to call the Great Recession, that started with a housing bubble that burst in 2007 and 2008. And just to explain how the Federal Reserve stepped in, because that was not, what they did during that crisis was not a normal function of the Federal Reserve System. For a number of years leading up to this bubble that we had, mortgages or housing loans were given to individuals who did not have the ability to repay these mortgages, especially as their adjustable interest rates increased. And as a result, there were an awful lot of banks that held mortgages that were not going to be repaid. And so they quickly sold these to other banks, who then bundled them and sold them to other banks. Eventually, you ended up with some of the biggest banks in the land with millions upon millions of dollars of mortgages that could not be repaid. So the balance sheet said that they had X number of dollars and X more coming in, and they really didn't. And as they began to tumble, the financial institutions that insured them began to tumble with them. And the financial institutions that had purchased their stock began to tumble with them. And we saw another crash, not like the stock market crash of 1929, but a complete crumbling of all these different types of financial institutions in rapid succession. Well, the Federal Reserve Bank was designed to prevent bank failures. They weren't necessarily designed to prevent investment house failures or insurance company failures. Yet, they saw what they called a contagion that was developing so rapidly and so quickly that they felt, with or without legal authority, they needed to step in and do something to prevent a complete global meltdown of the financial system. They did this by calling all the players into the room and basically negotiating deals as to what companies would fail and which ones wouldn't, and what companies would purchase from other companies. And they realized there were all what they call all of these toxic assets, these bundles of mortgages and financial papers that looked great on paper and were empty and had nothing behind them. So the Federal Reserve System started a new program called TARP, the Troubled Asset Relief Program. And in this program, they basically said to banks and other financial institutions, we will purchase this bad debt from you. You have a bunch of debt that's never going to be repaid. We will purchase that from you for its full value price. And so millions upon millions of dollars went from the Federal Reserve System to the banks themselves, and they bought these mortgages and these financial instruments that would never be repaid. As time went on, it was discovered that the Fed actually did not do this themselves, but hired Chase Bank to administer the program. As more of the activity was revealed, it turns out that the Federal Reserve System also helped out Deutsche Bank and European banks who were involved in the exact same situation. This incident, this chapter in American history, points to both the strength and the danger, the positive and the negative of the Federal Reserve System. It is arguably the most powerful financial institution in the world. And those who support what the Fed did will say they prevented a worldwide financial catastrophe, the loss of everyone's pensions, the loss of everyone's bank accounts, the loss of all major banking institutions in the Western world. Those who are its detractors, however, point to the fact that this is an incredibly powerful institution. It is practically a branch of government that has almost no government oversight, that is operated by private bankers, that has very little accountability to the public, that has never been audited itself, and that you have this incredibly powerful institution that can do good or bad with no answering to democratic institutions. Well, for good or for bad, the Federal Reserve System has expanded into other areas as well. They are the administrator of your checks. They're the reason your checks clear practically overnight. They are the guardian of gold. Underneath the Federal Reserve Bank of New York is 40,000 tons of gold from every country in the world. And when countries need to move balance of payments from one country to another, they use forklifts to move pallets of gold from one country's room to another. They are the controller of the currency, meaning they decide how much has been lost by going through the washing machine in your pocket, and how much needs to come out of circulation because they're ripped or torn dollar bills, and they replace them. They are the lender to local banks, and just like the first national bank was way back in the late 1700s, they are the national bank of the United States. When you get your Social Security check, when you get a check for your income tax refund, it is drawn on the Federal Reserve Bank, because that's the bank or the banking system that the federal government uses to process all of its revenues and expenditures. So this has been a brief overview of the monetary policy, the monetary system as evidenced through the Federal Reserve. And we want to thank the Museum of American Finance here on Wall Street, which has all these wonderful exhibits that enabled us to come in today and make this film. So thank you very much.